Every company tells you two stories. One is written in dollars, the other is written in pictures, promises, and glossy pages full of smiling people and windmills. Usually, both stories matter. But what happens when the pictures are doing a little too much smiling? Meet Ava, analyst in training. She found a company whose numbers looked fine, whose brochure looked greener than a superhero's smoothie, and whose claims raised one very important question. Which story do you believe? To answer that, we need a new team. Not to replace the financial statements, to reveal the part of the story that dollars alone cannot show. Welcome to the ESG files. And keep your eyes open. Something green is dripping. First, meet Finn, financial statements. Finn is a classic hero. Dependable, audited, dressed for a board meeting even while leaping off a skyscraper. Finn tells us what happened in dollars. Revenue, expenses, assets, liabilities, and performance. That is powerful information, but it is not the entire city. That is where ESG reporting enters. ESG reporting communicates sustainability-related risks, opportunities, policies, performance, and oversight. In other words, it expands the information set. It asks, what could affect the company's future, even if the effect has not fully shown up in cash yet? Is a flood-prone factory facing climate risk? Are employee safety systems failing? Is a board actually overseeing the promises management makes? Finn is not the villain. Finn is the experienced mentor. His flashlight is truthful. He just cannot light every corner at once. When E, S, and G switch on their lights, Eva can finally see the wider room. More light, more story. First on the roster, E, environmental. E watches the planet-facing side of the company. Climate-related risks and opportunities, pollution, waste, resource use, and other environmental factors. When a factory uses water, when a supply chain depends on stable weather, when pollution creates costs or risks, E is on the case. E's role is simple. The environment is not background scenery. It can change the whole plot. Next, S, social. Social covers people. That includes labor and supply chain standards, health and safety, product quality and safety, privacy, diversity, and inclusion. S can spot a broken safety system before it becomes a crisis. S asks whether workers are treated fairly, whether products are safe, whether customer information is protected, and whether a company's culture matches its big speeches. S's role? If people carry the company, people belong in the report. And then G, governance. G handles the rules of power. Board structure and diversity, executive compensation, lobbying and political contribution policies, bribery and corruption controls, oversight practices. G does not make the boardroom boring, G makes the boardroom accountable. Because when nobody is watching the decision makers may start writing their own happy ending. E, S, and G are not three unrelated side quests. Together, they help tell one company's fuller story. E covers environmental exposure. S covers people and stakeholder systems. G covers who sets the rules, who gets rewarded, and who is responsible when promises go wrong. 3 heroes, 3 beats, 1 city. Ava opens her notebook. Okay, team, give me the field guide, not just the catchphrases. Excellent question. ESG is useful only if each letter leads you to a real question, a real source of evidence, and a real possible business consequence. Start with E. Environmental reporting is not just about planting a tree for the annual photo. It can include climate-related risks and opportunities, pollution, waste, resource use, and other environmental factors. Suppose a company depends on a water-intensive manufacturing process. A drought, higher water costs, or new restrictions could change its operations. Suppose a company owns facilities in areas exposed to storms, heat, or flooding. Physical climate risks could interrupt production, damage assets, or affect supply chains. Suppose it sells a product that uses a lot of energy or creates difficult-to-manage waste. Those issues may affect costs, customer demand, compliance, and long-term planning. E's job is to connect the planet-side issue to the company-side consequence. Now S. Social reporting is about the people whose labor, trust, health, and information make business possible. Labor and supply chain standards ask whether workers are treated appropriately, including people far beyond headquarters. Health and safety ask whether someone can go to work and go home safely. Product quality and safety ask whether customers can rely on what they buy. Privacy asks how personal information is collected, protected, and used. Diversity and inclusion ask whether opportunity and decision-making are broad enough to reflect the people a company serves.
S does not assume that a smiling recruitment photo proves anything. Ava learns to look for policies, performance measures, patterns, and evidence of oversight. A company can say that safety matters. S asks what is being measured. A company can say that privacy matters. S asks what controls exist and what happens when they fail. A company can say it values suppliers. S asks how does it know conditions are meeting its standards. Finally, G. Governance is where ESG becomes a question of accountability. Board structure and diversity can affect how decisions are challenged. Executive compensation can influence what behavior is rewarded. Lobbying and political contribution policies can show whether outside influence is being governed. Bribery and corruption controls can reveal whether a company has guardrails when pressure rises. Oversight practices ask the most important governance question: who is responsible for monitoring this issue, and what authority do they have? Think of G as the control room. E identifies environmental exposure, S identifies people and stakeholder exposure. G asks whether the company's decision makers can see those exposures, respond to them, and be held accountable for their response. That is why one letter never tells the whole story. Environmental, social, and governance factors interact. A climate event can affect workers. A weak board can ignore safety warnings. A poor incentive plan can reward short-term appearances over long-term resilience. The complete team-up is the point.
Now, Ava spots another caped figure and asks the question that trips up almost everybody. Wait, is ESG the same as CSR? Enter CSR, ESG's big-hearted cousin. CSR means corporate social responsibility. Both CSR and ESG can address how companies affect people, communities, and the world. They are family, but they do not always have the same mission. ESG reporting is often structured to help investors assess risks and long-term value. It speaks to capital markets, while still mattering to other stakeholders. CSR reporting leans more broadly towards stakeholder responsibility and social impact communication. Think of it this way: ESG is wearing mission gear and briefing the investor front row. CSR is handing out flyers at the community gala. Both may care about doing good. They simply put the emphasis in different places and speak to somewhat different audiences. So do not turn the cousins into rivals. The key is distinction, not drama. Well, not that kind of drama. We have enough of that coming. Why do companies suit up and report on ESG in the first place? First, transparency and dialogue. Investors, employees, customers, and other stakeholders want to understand what the company is doing and why. Second, investor demand. Long-term risks and sustainability performance can matter to people allocating capital. Third, risk management. You cannot manage what you refuse to see. ESG reporting can help a company identify, manage, and communicate environmental, social, and governance risks. Fourth, access to capital, long-term performance, and regulatory compliance. Clear, credible information can matter when companies seek trust, funding, and permission to operate. And fifth, credibility. Because the moment a company tells the world it is greener, safer, fairer, or more responsible, somebody should ask for evidence. Uh-oh, here comes greenwash. Greenwash is not always a cartoonish liar shouting, "I am deceiving you." That would be too easy. Greenwash is charming, plausible. He paints a windmill on a smokestack and says, "Look, renewable vibes." Greenwashing is the risk of portraying activities as more responsible than they substantively are. The team's answer is not vibes. It is evidence, context, and honest reporting. Kadrip. Caught you! But even a well-designed ESG report raises a bigger question. Can we trust it? Here is the first challenge: verification. Financial statements often receive independent audit assurance. ESG information may not receive the same assurance, though some firms voluntarily seek it. Ava learns to check the badge, not just admire the cape. Second, comparability. Companies can choose different metrics and reporting approaches. That can make it difficult to compare one company to another or even the same company across time. If one hero measures pollution in buckets and another measures it in meteor showers, the scoreboard gets strange fast. Third, rating differences. The ratings panel arrives with 3 scorecards for the same company: 92, 54, and this company is a sandwich? Different third-party rating agencies can reach different conclusions because they use different data, weights, and methodologies. A rating is a clue, not a magical answer. Finally, reporting frameworks and standards can help. Frameworks associated with sustainability accounting, global reporting, and European sustainability reporting standards aim to improve consistency, structure, and comparability. They cannot erase every judgment call, but they help the city speak in more compatible formats. So Eva's role becomes trust but verify.
Ask what was measured. Ask who checked it. Ask whether comparisons are actually fair. And ask why two ratings disagree before deciding that one is definitely wrong.
Ava has one more question. If ESG information can be complicated, how do I actually read a report without getting lost in the cape swishes? The team gives her a 4-step evidence check. Step 1, identify the claim. Is the company describing a goal, a policy, a performance result, a risk, or an oversight process? Those are not interchangeable. We aim to reduce emissions is a goal. We reduced emissions by a measured amount over a stated period is a performance claim. The board reviews climate risk every quarter is an oversight claim. Ava circles the verbs aim, reduce, review, verify. The verbs tell her what kind of evidence she should expect. Step 2, check the measure. Does the report explain what is included, what is excluded, what time period is being used, and how the information was calculated? If the company reports fewer injuries, does it explain which employees and contractors are included? If it reports lower emissions, does it explain the boundary and method? If it reports a strong diversity outcome, does it say which jobs, locations, or levels are counted? Comparability gets better when the measure is clear. Step 3, check the assurance. Independent audit assurance is familiar in financial statements. ESG information may be treated differently. Some firms voluntarily seek assurance for selected sustainability information. Ava does not assume that every glossy chart received the same level of independent checking as a financial statement. She looks for the assurance statement, the scope, the provider, and what exactly was examined. The badge matters, but the fine print on the badge matters too. Step 4, compare carefully. Different companies can use different definitions, boundaries, data, weights, and methodologies. That means the same ESG rating can be built from different ingredients. The ratings panel scores do not become useless just because they differ. They become a prompt to investigate. What data did the agency use? Which issues did it weight most heavily? Did it focus on risk to the company, impact on the world, or a mixture of both? A weighting can be a starting point for questions, not the ending of thought. The same care applies to frameworks. Reporting frameworks and standards can improve structure, consistency, and comparability. They are helpful allies because they give companies a clearer way to organize disclosures. But a framework label alone does not make every claim equally persuasive. Evidence still wins. That is Ava's upgraded method. Identify the claim, check the measure, examine the assurance, and compare carefully. Then monitor regulators, standard setters, framework organizations, and official press releases, because the rules and expectations can evolve. It is not glamorous detective work. It is better. It is the kind that catches the drip before the brochure becomes the whole story. For years, much ESG reporting was voluntary. Now the city's regulation beacon is lighting up. The direction of travel has included expanded mandatory climate-related disclosure, climate risks and greenhouse gas emissions, mitigation or adaptation expenditures, board and management oversight of climate matters, and financial statement note disclosures related to certain climate events and activities. But pause the action. This part needs Ava's most important investigator rule, then versus now. A chapter can describe proposed or adopted requirements at a particular point in time. That is not automatically the same as what is currently required for a particular company in a particular jurisdiction today. Rules change by place and over time, so treat this as a historical and illustrative discussion of expanding disclosure, not a fixed statement of current law. Greenwash tries to sneak through the legal fog. Rules are complicated, he says, so maybe nobody will notice. Ava writes in her notebook, complicated is not the same as invisible. When the rules change, check the current regulator, the company, and the jurisdiction. The villain never truly leaves. Greenwashing evolves. Reporting rules evolve. Frameworks evolve. The job is not to memorize one report and call it a day. The job is to keep watching. Regulators, standard setters, framework organizations, and official press releases. Stay current. Check the evidence. Compare carefully. And remember that the cleanest looking brochure is not a substitute for a well-supported claim. Ava looks at the windmills, the financial statements, and the ESG team. Now she can read both stories. The dollar story tells her what has happened. The ESG story helps her see the risks, opportunities, policies, performance, and oversight that may shape what happens next. And when Greenwash tries one last perfect disguise, Ava does not guess. She checks. She finds the evidence. Ka-check. Case closed. For now. Environmental, teal green. Social, blue purple. Governance, magenta. 3 lenses for a bigger story. The city is still changing, the rules are still moving, and somewhere beyond the skyline, a mysterious new disclosure format rises into view. To be continued.